Hi, thanks so much for tuning in. This is BQ Prime. My name is Alex Matthew, and today is the perfect day to talk about fixed income and strategy. The reason being, the yield curve has inverted. It's not something that happens very often. In fact, the last time it happened was 2015. And what that means is that the yields on the shorter end of the yield curve have actually moved higher than the yields on the long end. We're joined by Marzban Irani, who is the Chief Investment Officer, Fixed Income at LIC Mutual Fund. And he's going to help us understand why this has happened and what the prognosis is for the yield curve in the rest of the year. Thanks so much, Marzban, for taking the time. First
My
of all,
pleasure, Alex.
why have yields on the short end moved higher?
Alex, the yields have this movement has to do something with the demand supply in the market at this point in time. There is a huge demand at the long end of the curve, and there is no supply at the long end of the curve because the options, the central government borrowing program is done. It's through for this year, and now it will start in the month of April. So this month, there is no supply in the 10-year, 15-year, and the longer end of the curve. That is one part. The other thing is there is additional supply at the short end of the curve, where the treasury bills excess, supply is there this month. And till the last week of this month, every week we are going to get supply on that. And that is one part. The other part is during this being the month of March and year end is also approaching. There is advance tax. At this point in time, normally liquidity tends to be a little tighter. So hence the bidding is happening that way. Last evening, yesterday we saw one auction on the treasury bills, and there the yields inched upwards, and hence we are seeing this inversion. But as we go ahead, this should not be a concern.
So this is not, and I'm guessing I want to bring this up because when you talk about yield curve inversion and you look at it from the perspective of the US yield curve, a lot of people talk about that as a sign of recession. This is not that. This is basically a liquidity issue on the short end. There is increased supply. Talk to us about the supply. It wasn't expected to go up the way that it did in the month of March. Is that correct?
Yeah, I mean, this was announced, indicated at the time of budget that there will be additional borrowing in the treasury bills, and I think that has come through. And I think the market knew about it. That is one thing. We have seen some tightening. What has happened? One more, just to add to all these things. Globally, also the yields have inched up a little in the last few days. The data which has come out is was not very favorable at this point, and hence over here the market is reacting that way. Uh, as I said, over a period of time, this should stabilize. This cannot be a long term kind of a phenomena because we are not in that we are not seeing that type of recession kind of a scenario over here.
Certainly. Now, in the last monetary policy meet, when the Reserve Bank of India governor was speaking about liquidity, he said at that point quite definitively that systemic liquidity was comfortable. But that seems to be the core of the question today and the reason why the yields have behaved the way they have. What's your understanding of systemic liquidity as it stands right now?
So my reading on what the governor said, during the last policy was, I think he's on the liquidity. He said that I'll keep the liquidity neutral. The system liquidity will be more or less kind of neutral. It will not be in excess or in deficit. So I think that is what is happening. We have seen at repeated intervals whenever there is, liquidity is getting very tight. We see some intervention, and the government also is working very closely with the Reserve Bank. Last on the inflation data, when we saw the food prices inching upward suddenly, there were statements from the government, also from the Ministry of Finance, that we'll take necessary steps to ensure, on the export front, other things of the food items, that inflation comes under control. So on liquidity front also, I think RBI has been taking some proactive measures, and whenever it's required, they inject, infuse, or are taking the necessary steps.
Okay. Now, that brings me to your expectation of how the yield curve will move in the rest of the year. And I'm assuming when you say that this is a scenario that you expect to play out in March, where there is that tightness that should ease out. And then once the supply comes in on the long end, you'll see the yield curve normalizing again. That is my understanding of what you've said so far. So therefore, what's your fund house view in terms of how that yield curve will develop over the course of this year?
Sure. So, Alex, we have done some analysis. After Dr. Rajan had was when he was there and when he left, he did a lot of work on inflation targeting. And after we have taken a period after he left till now, how many times the yields has gone above 775? We did one analysis, and majority of the time the yield was below 775. So, what we feel is that structurally the interest rates are declining, and we have seen a peak of 9%, we have seen a peak of 8%, we have seen 775. This time we saw 760 and it turned. We feel that yields will remain in the 7.5 to 775 kind of range. It should not inch up a lot. When I say yields, I'm talking about the 10-year yield in the domestic market, more or less in that range. And I think that will be the peak, if you ask me. Last 2-3 years, we have seen in the pandemic period, we have seen very low yields because of the liquidity which was infused in the system. But now that has been absorbed, and now this carry is something that the investor should not miss out. This is a very attractive carry on your sovereign assets. So investors should, we are actually telling investors that they should put in money in the fixed income funds. As you rightly asked, that going ahead, the yields may inch up here and there, 10-20 basis points, because we can't catch the peak at the bottom. But more or less, it should be in that range. And see, the demand part, which I told you, yeah, the supply is, as I told you, there was additional supply of T-bills during this month. But from next year also, from April onwards, when we see the borrowing program, the demand continues to be there at the longer end. The size of insurance companies, the size of mutual funds, the demand from pension funds is on a very, very large scale. And hence the demand will continue to be there. So we are expecting yields to, even if there is some negative data and there is some pressure, temporarily there can be some yield uptake, but that is not a sustainable level. Eventually yields have to decline and move lower from here.
Okay, so it's interesting that you say that, because over the last couple of days, Marzban, we've been reading from the Fed the comments by the Fed chair, Jerome Powell, and he's talking about the need possibly to increase rates much higher than was previously anticipated, much quicker than was anticipated as well. He said very clearly that there is no decision that has been made about the March policy, which is around the 21st, 22nd, or 22nd, 23rd, if I'm not mistaken. And there could, in fact, be a rate hike, but that's not guaranteed. Can India stand in isolation? If the Fed raises, we'll have to raise. That's the expectation, right?
Of course, we can't stand in isolation. We will have to react because there'll be pressure on the currency. But if you look at the rate hikes which have happened, forget about this period, this immediate period, this March month Fed's reaction. But if you see the rate hike cycle, from the month of May, which we saw over here also, and a little earlier for US and other places where the rate hikes have happened very aggressively, the yield movement has not been very aggressive. So that is the point I'm trying to make, that there can be a rate hike, but markets are factoring in all that, and markets are not reacting in a big way. Last week also there was, I think, around 20-25 basis, because from 380, 390 we saw the US yield moving towards 4.08 and then turning. So we are seeing those type of 15-20 basis point of big movements in the US 10-year yield, but that type of reaction is not there in the domestic market. So rate hikes might be there if the Fed, because the Fed fund implied probability is also indicating 3 more rate hikes there. So there can be a rate hike here in April, depending on what the situation is. But the market is factoring all this in the current prices. People are aware when they are buying and taking positions at these levels.
Okay, so that's interesting perspective. The last question before I ask you about strategy is how long you anticipate that yields will remain elevated, because again, this is coming from what the US is talking about in terms of inflation and the requirement in all probability to keep yields elevated for a longer period of time. I know the Reserve Bank of India governor has repeatedly stated that domestic factors and inflation in this country are what determine interest rates and policy rates. But it goes back to what we were talking about earlier. You can't stand in isolation in a globally connected economy, right? So how long do those yields stay elevated?
So I think this year is the year of carry, and till September, December, we'll see the yields higher like this. Seven half kind of levels between 7 quarter to 7 half. The yield curve is almost like flat, whether you take 1 year, 3 year, 5 year, 10 year in that 7 quarter to 7 half. So it will remain in those. In fact, we discussed the inversion also. So it will remain more or less in this range till in this year. But next year at 24, we'll see the yields declining. See, it's not. See, it's like market always reacts a little in advance. Market participants tend to discount some events in advance. Why so many rate hikes have happened, but your yields have not gone up by to that extent? Why? Because the market always discounts all this in advance. So on a similar way, there can be some rate hikes, so yields will remain more or less here. Then there will be a period when there will be nothing like. But there is, if there is any indication that 3 months, 6 months down the line, there is going to be a rate cut or that kind of scenario, then the markets will react early, and that will bring down the yields. So we have to look for that type of signal and wait for the yields to come. But till then, I would say that it's been 2 3 years and we have seen very low yields on the fixed income side. Let's enjoy this 7 half kind of a carry. I mean, investors should get this carry. I mean, this is a very good level to invest in a sovereign paper. Uh, Government is spending on infrastructure, government is spending on health,
Sure.
education, all these things, and hence they are borrowing. The borrowing amount is on a
Absolutely.
huge scale,
So,
and hence we
so
are getting these type of yields.
yeah. So you mentioned the word carry several times. So for those that are not familiar with it, perhaps explain it, how to benefit
So
from carry, what you mean by carry, and what is the best strategy to employ in the current scenario.
by carry, I meant that the rates have inched upwards. They have reached their peak, kind of a thing. When I say peak, I mean a range of around 7 half to 7.75, as I mentioned earlier. So stay invested in fixed income, and when you stay invested and you get this 7.5% or whatever, which is there currently 7.45 to 7.5. That is your carry basically. You are holding on to that position, so you are getting that benefit, on a risk free asset. And then when the yields turn, when the yields decline, one would benefit from the capital appreciation also, besides your higher interest, the carry, higher interest rate.
So therefore, take positions in the longer end if you possibly can. If you
So,
get a
so
so what I'm asking is, if you have the opportunity to lock in yields in a target maturity fund that gives you what 8 9 10 years of distance or of tenure, you should do that. Is that what you're saying?
So there are two things to it. One is, normally we tell people that invest based on your risk appetite, and the yield curve is flat. So a lot of people are asking that on a risk reward basis, it's better. The sweet spot is 3 year to 5 year, if you ask me. So that is there. There is no doubt about it. But what I've been telling investors is that, which I told you some time back, is that structurally your interest rates are declining. Last 2 decades, what I've seen, there was a time when the PPF rate was at say 12%, then 10, then 8. So it has been declining in a structural manner. Same thing with Kisan Vikas Patra. So we are in that kind of a scenario where the interest rates are declining structurally. So it's better to lock into long-term assets and stay in. If you have long-term money, stay invested. You may not get to see these type of levels. There was a time when we would say that 8% is something that you may not get to see. Today it's a fact. We have not gone to that 8% level on the 10 year. So I'm saying that the 7 half or 7.75 is something that we should benefit from, and we should go as long as possible and stay invested.
I specifically asked you that question because there has been advice that has been dispensed about that 3 to 5 year period. Because the question is, why would you take duration when the yield on the 3 year paper is the same as the 10 year paper? But you've explained this very, very well. Thank you so much, Marzban, for taking the time. Pleasure
My
speaking.
my pleasure. Thank you.